All right, welcome back to another episode of Not Financial Advice. Hit that like button, subscribe to the channel, and we're going to get right into it. So, today is Saturday, January 6th, and I have 6 stocks subscribers have requested that I review. So, we're going to get into it as fast as we can. We're going to be moving pretty quickly on this, and we're also going to go ahead and break this episode up into chapters. For any of the subscribers, if you want to just go to see the stock you requested's review, you can use those chapters. Otherwise, I'm going to be doing this essentially as raw footage without a lot of editing. So I can bring as much value as possible to subscribers, but also make sure that I'm using my own time wisely here. So one of the benefits to this is you'll be able to sort of get a behind the scenes look of my process and how I look at stocks, how I research stocks, how I value stocks. And so if you want to stick around for the whole thing, that's also cool. But we're going to get started with a real quick recap of how my first trading week of January went. And then we're going to get into those 6 stocks right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
S&P 500 was up 0.18%. My portfolio was up $275 or 0.4%. So I had sort of 2x the market on this day, and it was all attributed towards marijuana stocks, which historically have been some of my biggest losers. So there's the 3 stocks that about $100 of gains that lifted my portfolio above the index. Other things that did well were defensive names, value, or higher debt names, consumer names, Tyson Foods, so consumer defensive, but also Meta, a decently valued tech growth stock. So sort of a more mild continuation of the everything rally. Market was weighed down by Pepsi, Coinbase, Estee Lauder, McDonald's, Waste Management. Honestly, some of the defensive names that either have some headwinds or maybe a bit overvalued. So that's the recap on the market, and we're going to jump into our first stock, which is Robinhood. So I'll ask you to like the video and subscribe to the channel. And we're going to start right here just with the price chart. So this is a 2021 IPO. The issuance of a lot of new shares in newly public companies, rather, that's a sign of a hot market. Companies like to go public when the market's hot. And so when you see a lot of IPOs, that can sometimes be a predictor of a pullback or correction or crash in the market. And so this is a mid 2021 IPO. Rule of thumb on IPOs, wait 2 months. No, thank you. Wait 2 months. So the stock is down 66% all time. But if you had waited about 2 months, you could have been down 8% or down or up 8% as opposed to down 66%. So there's the deal on the price chart for Robinhood. Now let's see if we can figure out what a fair value for this $12 stock is. Taking a look at revenue, it looks like they've gone in 2019 from 275 to 1.3. So they've 5x their revenue in 4 years. It's a lot of revenue growth. So that's a good sign. But we don't have a full 5 years of data to go from here. Usually, to value a company appropriately, you're going to want to have 5 years of full data, and you're also going to need to be able to average 5 years of free cash flow. And so when we look at how much Robinhood is diluting investors, it's a lot. So while they have that free cash flow, even at times when they didn't, they pay their executives in stock, which is essentially stealing returns from the investor. So when we look at stock-based compensation, adjusted free cash flow, this negative number is bigger than that positive number, and this positive number is smaller than this negative number. So they don't have free cash flow. I can't value the stock on free cash flow if they don't have any. They also have negative earnings per share. They are raising cash, but they have a horrible return on capital employed, and they're diluting shareholders. So this is where my research on this company stock stops. I would never buy it. If you are interested in Robinhood because you use it, or if you like the idea of investing in stocks of companies where people buy stocks, you could consider things like Charles Schwab, Fidelity, or BlackRock. And then again, there's also, some crypto transactions that happen on Robinhood. So if you're looking for exposure to stocks where crypto um, transactions occur, you also could, look at Coinbase. But as far as Robinhood goes, I watched a podcast with a smart commentator, Josh Brown, where he said that the customers of Robinhood are not worth that much because they're Zoomers who don't want to pay for any financial services whatsoever. They're there to just trade commission free and hard to monetize. So this one's a pass for me. And now what we're going to do is we're going to move to our second of 6 stocks. Like the video, subscribe to the channel. Here we go. So next one we're looking at is Visa. So this is a stock that I own. And it's a stock that I like. One thing that's cool about this stock is that they they don't make money from credit cards that they issue to banks. It's actually the bank that makes money on that interest, but they are a toll booth company in the sense that they get a percentage of every swipe that happens, be it in person or online. They also um, charge banks for providing the cards. I do, in fact, believe. And then the third part of their revenue is sort of in playing the spread between cross-border transactions. So they're, a card network provider that connects a consumer to a merchant to a bank and vice versa. And that's the same exact um, business model as MasterCard, which we're also going to be looking at. So this is one that definitely looks like a power stock. If you wait too long to try and find a dip to buy it, you might not be able to buy in. So this is going to be one that probably has really good. I know that it has good fundamentals, but the valuation is always going to be a little bit stretched. So let's take a look at Visa. Large cap company, 26 forward PE. 16 times price to sales. Free cash flow yield of 3.54%. That looks really great. Low dividend with a huge amount of upside, a dividend growth name. Revenue, it's up and to the right, impeccable. The cross-border revenue, the only year you really saw this stock noticeably go outside of its trend, which is actually pretty frickin' remarkable, is this black swan event where cross-border revenue was down, but didn't hurt it that much. And the increase in e-commerce helped to keep it sort of in line. But even in the Great Financial Crisis, 2007, they had higher revenue in 2008, 2009, 2010. That's nuts. So a strong stock about probably about this 5-year number here, 9.6% revenue growth. That's probably in line with what one could look for in the future. Maybe 7, 8, 9% revenue growth. Looking at free cash flow, it's fantastic. Absolutely fantastic. This is, I think, in the top 1% of companies in the United States. A phrase that I hear a lot of financial YouTubers use, and I'm not sure how you make that determination, but I guess I just did. So I feel pretty strongly about it. Dividends up and to the right. They've never cut them. Cash and debt, It's about even. Um, in the past, they've had more debt than cash, and now they're keeping those numbers in a parity to each other. I'm sure they have a better credit rating than the United States government, so that's great as well. Earnings per share steady and up and to the right. Shares are going down always. They're buying back shares always. So they issued shares in the tail end of the great financial crisis. Um, it's the one knock I could have on them. But since in the last 10 years, they've been going down about 2.3% a year. So even there, you're sort of pacing inflation if you think about it and the way they're buying back shares. Returns on capital employed. Let's look over the last 10 years. This looks like a nice median number here. 21%. That's high. Really great returns on capital employed. Historical valuations look at a 10-year basis. It's cheap considering or compared to historical valuations. Yeah, this is a fantastic company. I've valued this one before. Um, it's probably on the upper edge of its fair value, but something with such an impeccable balance sheet warrants that. So love this one. Let's take a look at MasterCard next. What I'm also going to do is I'm going to compare two metrics between Visa and MasterCard because I think that's important. So we have 10-year revenue growth of 10.7% on Visa. We had that median return on capital employed around 21%. So write this down. This is going to be a good way to compare Visa to MasterCard. 10.7% revenue growth. Um, 21% ROCE. And I also want to look at their bottom line profit margin. It's right around this number. Yeah, wow, stellar. 45%. This is going to be the best way to compare Visa to MasterCard on these three metrics, I think. We'll also sort of eyeball the dividend on this. Okay, so looking at the dividend on MasterCard, it's similar, but it looks like its dividend growth has a little bit of a longer runway to it, as you can see there clearly. A higher PE, maybe it's justified, maybe it's not. Lower free cash flow yield. Let's take a look at revenue growth on MasterCard. It's about the same. Let's look at free cash flow. Looks great. Looks very similar to Visa. Same exact business model. These two dominate. They're a duopoly. Their cash and debt position is worse, but super not concerned about it with this quality of a company. Earnings per share look great. Looks very similar. This is probably going at a quicker clip than Visa on dividend growth. Shares outstanding are going down. That looks great. Okay, this is what sets it apart. Much higher returns on capital employed. So all things considered, this could be a reason that MasterCard might be preferred over Visa, although one could own both. Let's look at relative valuation over the last 10 years. Relatively cheap. That's fantastic. And then let's look at their profit margin. Oh, let's make sure I'm looking at the right thing. Okay, that's return. Yep. So their return ROCE is high and profit margin. This looks like a median number here. A little bit lower, but about comparable. So they both look great. I like Visa for its profit margin, and I like MasterCard for its return on capital employed. Both great, super strong names. Um, I'm sure. I'm sure that they're both, pretty powerful stocks here. Yeah, it's going to be one that's hard to find a dip on. So it's probably at the upper range or outside the upper range of its fair value, but based on its low historical PE multiple, if this is something that you're interested in, um, if it was something that I'm interested in, and I am, and I own Visa, what this is just reminding me is I'm going to personally be looking to add some more Visa based on the powerful performance of these types of stocks. So we're going to go on to the next stock, which is a French maker of spirits, Pernod Ricard. Okay, this is this is a big deal. Thanks to the subscriber who brought this to me. So, Absolute Vodka, Jameson, Kahlua, Malibu, Glenlivet. This actually has a lot of great names on it. I'm super excited about this. Wow. Okay, thank you so much. So, let's take a look into this. Take a look at the chart first. This is fantastic. So, this is a late 2021 IPO. If you're new to investing, when I look at this chart and say it's fantastic, you might be a little bit confused. This looks very promising, potentially. I doubt people are drinking less hard liquor across the whole world from late 2021. Not 32% less people drinking hard liquor. Those are some strong names in this portfolio. Let's look at this company. This looks fantastic. Okay, a lot of these metrics we're not going to have. They pay dividends. Let's check out the dividends. Qualtrum doesn't have full data on international stocks, so we got to check it somewhere else. Y chart says 2.95, so 3% dividend yield on Pernod Ricard. A safe, high-yielding dividend stock. That's what you get with international stocks. It's paying 3% at a 41% payout ratio. 40%. I'm seeing 40 or 41% in multiple places. Yeah, I feel confident about that. Okay. Um, so it's a high-yielding dividend company. with a safe payout ratio. Let's look at revenue growth on this company. Okay, so it looks to be, a little bit slower growth. It's probably been around for several decades. 3.54% revenue growth. I don't hate it. Let's look at free cash flow. See if these people do really good stock-based compensation. They hold it level. They're not crazy with it. They even reduce it when they have less good years. So an investor-friendly company. Let's look at free cash flow growth. It's going up into the right, not by huge amounts, but the trend is in the right direction. Looks like they were hit by. It looks like a lot of their revenue probably comes from bars, restaurants, event centers. So just something to keep in mind. Yeah, this is a good one. Let's look at earnings per share. Might be a glitch. Earnings per share look great. Dividends on international stocks are usually paid out once or twice a year. Yeah, twice a year. And you have to pay taxes on dividend stocks. So I hold dividend stocks in a taxable portfolio because if you pay taxes on the dividends to the government where the company comes from, you can then write those off on taxes. If I'm not confused, that's what I believe that I do, to the best of my recollection. So just something to have awareness of. Dividends are going up and to the right. Great dividend growth rate. Great dividend growth rate. This will probably end up being a 5% yielding stock. They've got a lot of debt. In a lower interest rate environment, that can be less of a hindrance. Not thrilled about that, but if that's the only bad thing that I find, it's fine to me. Okay, solid returns on capital employed, for essentially a defensive stock. Shares have been 133, 1.3. Shares have been going down for over 10 years. Sales and marketing is their biggest expense. Well, $2 billion with $700 million of capex, $2.7 billion in expenses in 20. Let's just make sure we'll just look at 22. Okay, $2.2 billion in 22 of expenses. Revenue. Okay. I'm not a wizard with this type of metric, but it doesn't look like the expenses are out of control. This looks like a hell of a company. I'm gonna consider getting this for myself. Great find. Um, thanks so much for bringing this to my attention. Awesome, awesome, awesome looking company. Okay, we're gonna move on to the next thing, which is Marathon Petroleum Company. Love the way this chart looks. I think I could make some money on this. Okay, MPC stock. So this is a energy company, midstream, downstream. Not exactly sure what any of that means, to be frank with you guys. Hasn't been around for. It's been public for about 15 years. It's been just running since the COVID crash, up 560%. Yeesh. Looks like there's a little bit of consolidation here. That sometimes can indicate that a stock is going to move either higher or lower. This one is, this is one that I was a little bit cautious about. It's a company, they produce free cash flow. But they sell a commodity, and so commodities, you can't it's really hard to value commodities because, if there's 1,000 variables for a stock, there's a million valuables for the price of tea in China, as it were. And so I stay away from commodities like gold or pork belly futures or anything like that. Um, at the same time, this is a company that sells a commodity, and one company can be more efficient at selling a commodity versus the other. So I feel okay at looking at this. Looking at Marathon Petroleum, I see 11.4% PE ratio. Ford is pretty low. Huge free cash flow yield, 26%. Kind of nuts. People aren't wanting to pay a lot for that free cash flow. I wonder why that is. Uh, Very attractive looking dividend at a mega safe rate. This looks very, 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 very attractive. Revenue up and to the right. About 8 or 9% a year. Let's look at free cash flow. No problems with stock-based adjusted comp, really. Free cash flow is up and to the right. So these are the things that helped it run 550%. You would need to understand what this jump is to understand this company. Let's see if I can see anything that looks free cash flow looks great. Let's see if there's anything that between 21 and 22. They issued some shares, so that's not great. Although the trend is down. Did they issue shares to buy something and issue shares in 19 to raise money and then use it to buy something in 21 and then bought the shares back down? Did they buy something? Never cut dividends before, growing at a fantastic clip. They've got more cash than they historically have. Really high returns on capital employed in more recent years. Median is over 10%. Looks really good. Valuation on a 10-year basis, historically low valuation. That's also good. That looks like a great company. So definitely want to keep on the radar. Next thing I'm going to do is I'm going to take a look at one that was just requested, which is Spotify. I think this is a technology company that's located out of Canada. Might mean there's a little bit less attention on it, which might mean there's more of a chance for a misrating of the stock price. Chart looks pretty good to me here. Let's go to October 23 of 2002, which is said by some to have been the absolute bottom of anything that could potentially resemble. Well, it was actually where the everything rally started. Let me not misspeak, but it's ran 30%. That's better than some other companies in this time period. Okay. Let's look over here. Revenue up and to the right, 18%. That looks fantastic. Free cash flow. Let's see what they're doing with stock-based comp. Don't like that. I don't like that at all. Nah, I can't do this. Negative 360. Last 5 years, 360 plus, so 500. They barely have any free cash flow. Negative earnings per share. Negative returns on capital employed. Not necessarily a low valuation, rising expenses, diluting shareholders. I would never buy this. I'm done looking at it. So with all that in mind, thanks for tuning in with me. As always, if there's a stock you'd like for me to review, just go ahead and leave it in the comment section below, and I will see you on the next one. Peace.